Righto, money miners. Oh, still a bit hoarse.
It doesn't quite.
I'm still in there. I'm still in there. And tell you what, who's still here? Axis Mining Technology, the trusted advisor for drill hole survey instrumentation. And then this episode has a theme of transition, because we always recommend drilling companies to transition their drill hole survey instrumentation to Axis Mining Technology. And on the back of that theme, why not bring in a resident expert about energy transition, the great YJ Lee, calling in from Singapore, from Arcane Capital. YJ, welcome to the show, mate. How are you, Cobber?
Hello, good to be here, guys.
Oh, mate, we always, just when you got good energy at the start, it just flows, mate. Mate, transition, energy, it's all go. JD Trav, lead it away, give his CV. Who have we got on today?
Wait, I'm really excited to speak with YJ. He's got a he's been responsible for some of the pretty interesting thought pieces that have done the rounds on Twitter. I think he's done more to kind of distribute what the lepidolite cost curve is in China more than sort of anyone else. He's clearly a pretty switched on guy. He's in the right part of the world, and he kind of follows what's happening in China a hell of a lot closer than we're capable of sitting here in Perth. Pre conversation, we're just speaking with YJ about the Chinese stimulus that was just announced, and he goes, "Yeah, I saw that coming." So that's just an example of kind of how kind of tuned in he is, and I think with that he's going to bring a wealth of insight that we don't have. But YJ, I'm really interested to kind of unpack your thesis, because just if I could kind of summarize how I interpret your views, it's basically that analysts in the market in general are underestimating what the reality is going to be for the coming lithium demand deficit that, as you forecast it, you think it'll sort of surprise to the upside.
Yeah, so I think what we are seeing right here is the typical human psychology of always projecting the current state forward, right? For the next few years, and pretending things don't quickly change, just like this. And we saw this a few years ago when everything was crazy high. Lithium was $80,000 a ton, and everyone was saying higher for longer. I must admit, I was not one of those who was a short seller at that point, who saw the crash coming. I wouldn't claim to that. I did think that it would come down a little bit and stabilize at a lower point. So yes, I was caught out a little bit by the African supply, the new lepidolite supply. But at the same time, it was, patently ridiculous that that current situation would persist into infinity. And so here we are at the bottom of the cycle. And what we are seeing is that people are saying, there's more and more supply coming out. Demand is slowing down. We are not seeing the demand come in. I think both theses are probably wrong in the sense that demand is probably being underestimated right now. And there are many sources of new demand that we can talk about. And supply is probably overestimated right now, given the major cutbacks that we've seen.
About that African supply, YJ, how much was real? How much was speculation, from your opinion?
I would not say that African supply is speculation. If you look at the tonnage going out of Africa, if you look at the Chinese companies moving into Africa in a big way, what they are saying on their accounts, on their minds, the progress updates, the tonnages that they are at least aiming to produce in the next few years, it's probably real. But we have to also be aware that tonnage is not SC6 or SC even 5.5. A lot of it is coming out at probably grades of 3.5,
Yep.
And so that tonnage is probably overestimated in terms of lithium content.
YJ, we're sort of supply people, obviously based in Australia, focused on the miners. So why don't we start on the supply side before we get into the demand side of the equation? Why do you sort of say that the forecasts that these sell side and whichever sort of other analysts you kind of speak to are overstated in the coming period?
Yep. All right. So I think you guys saw my slides, but let me first describe how we look at the supply side here. Here at Arcane Capital, well, actually, should I have introduced myself and the company a little bit earlier?
Oh, mate, you just
But
do what you want, old
I just
Roger.
do what I want. Sure.
Go,
Anyway,
you
I
artist.
mean, to give you a bit of a background, at Arcane Capital, we manage two funds, one in Luxembourg and one in Singapore. The one in Luxembourg has a 15-year track record. I think our returns are pretty good. We delivered 240% returns over 15 years. That averages to about 8% a year. And you know that the S&P Clean and the Bloomberg Alternative Indices were down about 45% over this period, or negative 1 and 2%. So we kind of outperformed these indices by about 9-10% per year. So that's our original fund. And I think that's mostly based off top-down and bottom-up research that we do. So in Singapore, actually just this year, I'm quite excited because we just launched Singapore's first green metals fund. It's called the Arcane Green Metal Fund. And this fund focuses purely on the miners that we are talking about today. And so let me talk, since I've given you that bit of a background, let me share then how we do our supply analysis. What we do is that we track every single lithium mine in the world that we can find any information about. So on my spreadsheet, I've got 96 companies, and these are companies with firm mine plans or producing mines, okay? Not the speculative or pre-drill kind of companies. So 96 companies, 114 lithium mines around the world. I think that captures at least 95-98% of the supply out there. And then we forecast their production year by year from the last few years to the end of the decade, 2030. And doing this, we can build an entire picture of how the supply is going to look like in the next few years. And what I can share, I mean, the key takeaway from two main points from this supply analysis is that, one, the market can be a lot larger than people think. Based on this supply analysis, if you assume that lithium prices are high enough to make all of this supply come online, the potential supply can be about 4 million tons LCE. Nobody is saying 4 right now. They're all in the low 3s, right? So that's on a mine-by-mine analysis, we can get to 4, but the lithium price has to be there. And second, we did a bit of longitudinal analysis on our own analysis, compared our February forecast to today's forecast. And we've seen actually global delays and shutdowns of mines, basically reducing supply in the next 2 years by about 17 and 21%. That's pretty big. And not enough people are talking about it right now. Actually, if you guys want, you can pull up the slides, show it on screen. We can talk a little bit more about each area if you like as well.
Yeah, I mean that's an interesting point, right? Because these cost curves or supply forecasts, they are dynamic. It's not like you produce them at a point in time and then and that's what's going to happen sort of 2 years out. It's like, no, as the price comes down, these miners have every incentive to curtail production, and hence your analysis has to be dynamic as well. There was one part of your forecast and your kind of cost curves you put out, which like obviously gathered a lot of attention because of the lack of the ability of the West to somehow translate the public document sentiment. Like it releases everything from out of China, but you've gone as deep as anyone on what the reported kind of costs are from the lepidolite operations in China. And I was keen to just get your thoughts on what you found when you put that kind of cost curve together for the lepidolite operations.
Wow, that was a months-long operation in itself, trying to get all the data, trying to find the primary sources as much as we can. So a little bit about how we did it. We went into every single company, Chinese company that owned a lepidolite mine that we are aware of. And along the way, of course, some new names came up and that was a pleasant surprise. Maybe not for lithium producers, but for us, yes. And we went into their official WeChat accounts. We went into their quarterly and annual reports. And these Chinese companies, they don't release nice corporate presentations like Western companies do. There's no shiny presentation deck that gives you everything you want at a glance.
What do they put out instead?
Top
Words.
points.
Just words.
Yeah, look at their annual report. Hundreds of pages of Chinese words just running down page after page after page, tables and numbers and words. Wow, it was.
And do you sometimes just get market sensitive information just come out in these WeChat groups?
No, they're not really market sensitive the way we think they are, but they do share some. Oh, and I forgot to mention as well, the Chinese media articles. So some of these journalists do go to the companies, talk to them about their costs. Sometimes they disclose something, maybe a range, maybe a number, but so we have to put all these little pieces of information together and see whether it all makes a coherent sense. And we did find some. Yes, I think it all came together with some interesting implications. One, the size of the market obviously was a little bit larger than what people were thinking in 2022. And two, the cost was a lot lower than some people would say. Once upon a time, people would say, okay, brine, rock, maybe clay, and then all lepidolites as part of this imaginary cost curve going up. But no, we found that Chinese lepidolite actually spends almost the entire global cost curve in itself. We have low cost operations at the equivalent of 5,000 a ton, and we have high cost operations at about 60,000 a ton.
Wow! So you've got everything from Pilbara Minerals to core lithium. Is in that lepidolite cost curve.
Yeah, wow. So there is actually low cost lepidolite operations.
Oh yeah, of course. Wow. Yeah, some of it is probably due to better technology they have at the mine, better equipment or a lower stripping ratio at the mine than most people realize. And to a large extent, I've learned that some of these, okay, for example, one of the gold companies I met yesterday has a pretty low grade, right? But because of their very low stripping ratio, suddenly their cost is half of the next door neighbor, or not next door, but global competitor. So I think the same thing is happening in lepidolite. In some areas, you just might have good strip ratios, better strip ratios than some others, and that contributes a lot to lower costs.
So for those operations that have the lower costs because of the strip ratios, I'm not sure how much you dug into the future of these operations, but that can obviously change quite a bit in quite a short amount of time, depending on the sort of geology of the ore body. What did you kind of find on that front? Do you anticipate those ones remaining low cost for a number of years ahead, or was that really a short-term opportunity?
Well, okay, here, this is something that I don't think there's enough public information to be absolutely sure. But I think some part of the lepidolite supply will remain within global supply for the foreseeable future. And of course, we have the upper part of it that probably will not even come online anytime soon. We have brokers out there saying Chinese lepidolite is going to grow to 300,000 tons per year. But hey, are the companies willing to make a few $1,000s losses per ton? Well, I think we've got our answer from CATL.
Yeah. So do you then anticipate more sort of adjustments as CATL kind of put it? Is that sort of baked in for the back half of 24 and into 25 on your kind of numbers?
How? So my numbers I expect are probably a little bit still higher than what the market will eventually settle at. How I do this analysis is if the company says, oh, we're going to cut production or we're going to delay this new mine, then I move these numbers around. But if they do not make any such pronouncements, I just put it in the supply just to be a bit more conservative or on the upside, on the higher end, and potentially lead to an oversupply analysis in my supply demand matchup.
Why, Jay? With this, when you're doing this supply model to obviously then feed into the demand, how sensitive is it for the time it takes from blowing up the rock, shipping it to it, getting it into a battery? Is that like a quantifiable time, or is that a thing that can really cause a lot of variance in the model?
Yeah, so this is not something that we can actually do at on a reactive basis, because, well, we are tracking 100 over mines, and even if you update these once if what I'm saying is that we do these forecasts on an annual basis. We forecast their productions year by year, right? So it is difficult to say that they will produce in this part of the year and then it actually reaches the battery product in that part of next year. So we don't do that. But what I do is, if a mine is coming online in the middle of the year or in the fourth quarter, we do of course estimate a bit of a ramp up period plus the time that the actual quarter that they start, and that's how we do it.
We'll bring up your supply forecast on screen now, and I'm just looking at, so basically between February and September, when you did these numbers, so it's like 6-7 months apart. You basically show that with the announcement of some supply curtailment and some delays in developments, that there's, like, on your numbers, 21% less supply in 2026 than you had sort of in your model 6 months ago. Is that a fair characterization?
23, yeah. So this one, let me first say that the numbers here are on a pure mine level. So this basically captures what comes out of each mine at the global level, but it does not capture the losses that we experience going into refinery. So rock, we are going to lose 10+%. If it's lepidolite sources, we might lose as much as 20-30% of the mine gate production LCE during the refinery process. We're going to lose that much before we get to a battery product, right? So these numbers, supply numbers you see, are already too high from that perspective. And second, it does not risk these mines. In other words, if one of the companies is saying this mine is going to come online in 2026, we take the company's word for it. We put the first production, with a bit of a ramp up and time discounting for that year. But otherwise, we assume that the companies are on time, on budget, and things come online as planned. So the only way these numbers go up if there is excess, if there are new mines that come online that we are not aware of, but generally they go down because of delays, because of every other reason that to push supply back. So what we have seen here is that in February we were seeing mine gate supply of 2.1 million tons next year and 2.8 million tons the following year. But as of this month, we are looking at only 1.8 million tons and 2.3 million tons for the next 3 years. So these are pretty huge supply cutbacks, 17 and 21% down. Most of the regions are cutting back except Africa, which is the brown bit of the bars on top. You can see that Australia next year down probably 17%, South America down 22%, China down 15%. So these are pretty big supply cuts and delays.
And the implications of this, are you sort of suggesting that the market's going to enter a deficit much faster than the street is sort of currently anticipating?
Yeah. So what the street is anticipating is supply growth to be still pretty strong and slowing demand. And really, I think the slowing demand side is where most of this supply imbalance will be matched up. Later, when we go on to talk about demand, you will see exactly where all these sources are that take future demand way higher than Albemarle or anybody in the street are saying.
So one of the other components you speak about, YJ, in regards to supply is some of these analysts just putting blanket assumptions on recoveries and all these sorts of things. And that leads to, even if it's a kind of small percentage, if you magnify it over the whole market, it leads to a pretty big outcome. Can you speak a bit more to that, please?
Yeah. So if you think about it, one prominent broker has lepidolite supply at 300,000 tons, right? That's a nice round number. We can use that. So if 300,000 tons is the supply, I don't know whether they count it at mine gate or they count it at a refinery level, but probably it is mine gate because most of the analysts do the same thing that we do. Take the number of mines, take their capacity, take what they think is going to be produced, and then feed it into the supply model. But I don't know if they actually consider the fact that if it's lepidolite and the concentrate can be as low as 2.5% or 3.5%, and then that low grade concentrate gets fed into the mills into the refining, and where spodumene we lose maybe 10-15% at that point. For lepidolite we lose as much as 20 plus 30%. So on 300k, if you lose, okay, let's use the upper end. If you lose 30% of 300k, you are down 100k. That's exactly what the oversupply is this year, right?
So recent stuff out of the more ASX listed side of things, like what influence did like the likes of Mount Catlin going on to care and maintenance next year, Latin Resources probably getting pushed out a couple of years. We're hearing potentially there might be some further curtailments in WA, but we haven't seen it yet. How much of an influence does that have on your global model?
Not yet. Like I said, if they announce curtailments and shutdowns, then I will put it into the model. But I think the remainder are pretty all right, except one or two mines that I shan't name any names here, but producing a lower than expected grade of SC. That one
we know which one that is.
Yeah, so that one I think pretty high chance of being at least curtailed, or they might as well just shut it down at this point.
Well, that's interesting, right? Because the party currently taking that low grade spot is Ganfeng, and next month Ganfeng can just start taking good spot from Goulamina, as I understand. So why the hell would you keep taking shit spot from Mount Marion?
Oh, okay. So we are naming names now, all right? Yeah, exactly. So which is why I think that probably should shut down. And having said that, Goulamina is actually one of the few mines that we brought supply forward up this month. Yeah, just a couple of months ago, seeing what was happening with, unfortunately, what was it called then? Leo? Yeah, a couple of months of suspension and never being able to move the project forward on their own. Yeah, and everything that was going on, I thought that it was going to be years delayed. So I pushed it back, I think 2 years. And this month, I actually had to bring that forecast back up.
So how does the actual obligation work with Ganfeng for Mount Marion? They obligated to take that? Or is it MinRes have the control over whether it remains in operation or not?
No, I'm not aware of any firm offtake there. I didn't study who's exactly offtaking from Mount Marion, and we don't have a view into the commercial terms, unfortunately.
I can bet that you won't find it by going through Min's disclosures.
We'll get it through YJ's disclosure.
Yeah.
Obligation, I think of, speaking obligation, the obligation to use DSI as a ground support supplier. That is nearly the definition of obligation pertinent to the mining industry. Possibly, Trav, as you read in the paper, coming as part of the Department of Mines enforcing
we hear a lot about red tape and all that sort of stuff, and things are getting worse. But in this case, this bit of extra red tape making companies require DSI, mesh and bolts. I think that's actually a good thing for the industry.
I like that red tape.
Yeah, I like that red tape.
Yeah, red tape fits with the DSI logo, the red. That's I'm all for it. And I think it's obviously, come off the back of our just constantly telling everyone how bloody good and reliable DSI are as a ground support supplier. And I think it's a great thing for the industry going forward.
Is it, just an obligation because, mate, it's reliable. It comes faster. You're going to get it, more efficient. It's going to do a
You
better
know
job.
it's going to be in the ground, don't you, Trav?
It's got to, it's got to hold the ground up. Like you can
It's
count on it.
Everything. It's not going to hold the ground up if it's not on site. And DSI pride themselves in getting that bloody ground support to you. Oh, fucking good.
I've never seen a mining services provider with a better distribution network than them. They will get to you fast.
Oh, it's like a big bloody global spider. It's bloody brilliant. Go DSI.
YJ, why don't we jump to the demand side? Because this is really interesting, right? This has been a point of real contention, and kind of like you spoke to at the beginning of the call, is that's that real sort of jumping from a bull market mindset to the sort of bear market mindset, and it just sweeps across the whole market. So a couple of years ago, everyone's long EVs. They're going to be all we're going to see on the roads in 10 years' time, and now people are just saying they're not kind of hitting that. But your stance and what you're sort of betting on in the fund is, clearly bullish EV penetration, bullish lithium, and all these sorts of things. So can you kind of speak to the features of EV demand that you think the market is underweight, whether that sort of be stationary storage and all these other kind of aspects?
Sure. All right. So instead of giving you the presentation as I gave it at the event, I will take it a little bit backwards. Let's start off at the back of the demand area. Right, Albemarle's forecast. Okay, let's start maybe at that slide with Albemarle's forecast. That is slide 18. And so Albemarle start by saying that, we think that 2030 demand is going to be lower than what they originally thought, right? I think they shifted it down from 3.7 or 8 to 3.3. And of course, a huge chunk of that is EVs, with a little bit below that in grid, with a little bit below that in mobility. I wonder how what else. I think that should be buses and trucks that we say. But so it takes up to 3.3. But we think, and we are not even too aggressive on it, we think that EV penetration rates go up from 20% this year to 44%. So 44% penetration is not out of line compared to what the street and all the other companies are saying. And based on 44% penetration, and that includes BEVs and plug-in hybrids, we estimate 2.2 million tons of LCE demand from EV passenger cars. So if you do the numbers, that's exactly what Albemarle is saying. So EVs, that huge blue bar on top of Albemarle's demand chart, is probably 2.5, 2.3, 2.6 million tons there. So we are not that far from Albemarle. Where we really differ are the heavy buses, the trucks, and the grid demand. That's just BESS, right? We're calling it BESS here, right? So
this is a really non-consensus perspective that you have. You're far more bullish on the growth case of those applications than everyone else who just looks at EVs pretty much.
Yeah, I mean, it makes no sense for the whole market to be just only talking EVs when the new products are already coming up into the market. So e-buses, nearly all of China's tier 1 city buses are electric, and they're exporting it in a huge way around the world. I'm getting e-buses here in Singapore. We have, of course, mostly diesel buses, but more and more I'm enjoying, the quiet, strong air conditioned rides in these EV buses. And EV trucks, I was very, very surprised. 2 months ago, I saw a garbage truck, and it was a BYD electric truck.
How good's that? They're so noisy, garbage trucks. I'd love it. Less noisy garbage truck.
They still stink.
Yeah.
But,
if the lithium could make them smell different as well, that'd be great.
Yeah, but I totally did not expect to see a BYD garbage truck here in Singapore, and that speaks to how fast this segment is growing and how quietly nobody is focused on it. And if you look at the numbers, how big that demand could be, an EV bus has a battery of 300 kilowatt hours, right? That takes it to about 5-6 times a typical car. An EV truck has a battery of 600 to 800 kilowatt hours. That's literally 10 times the size of a car. So buses, we think, they probably go up 21% of new buses globally being electric by the end of the decade. I don't think is aggressive. trucks, our forecast for it is about 500,000 units by the end of the decade per year. I think this year we are on track for about 100,000 units EV trucks. So I think that's not too aggressive as well. It takes the penetration to 13%. So
YJ, where are those, just on the trucks quickly, is that dominated, that 100,000, by the US, by China? Where are we really seeing those sales happen right now?
Oh, it's definitely global. I mean, even in China, we're seeing some new EV trucks coming up from BYD. In the US, we are seeing the Tesla Semi coming up. Pepsi is doing huge trials with it right now. So once that's validated, I expect, adoption to be really quick. Now, but first of all, why, right? We all know EVs, the operating cost is so low, the maintenance cost is so low. Most high-use fleets are the first to transition to EV, especially if you're a big company that can afford the infrastructure right up front. Not sure if you guys are aware, but more than 85% of the taxi fleet in China have swapped to EVs, in new sales at least. Yeah, so definitely these high-use segments will be the first to switch. So just e-trucks, if we just focus on the e-truck segment alone, 500,000 units by the end of this decade. 500,000 units of e-trucks at 10 times the battery size of a car is literally
Just
5
about to
million
ask that.
cars.
Yeah, so is the lithium intensity of those units about 10 times compared to an EV due to the battery size?
Exactly. So a 600, 800 kilowatt hour battery consumes 10 times the lithium of a 70 kilowatt hour car.
Yeah. Yeah. And what battery chemistry are they using for the trucks and buses?
It's probably LFP.
LFP. Yeah.
Yeah, probably. I don't see well, maybe the Tesla Semi might run on an NMC. I need to check that out. But it does not require, high insane acceleration for garbage trucks or high top speeds, right?
Yeah. Yeah.
Yeah. So 500,000 units of trucks equals 5 million cars, right? Which analyst is saying that?
And so how much are you putting weight towards the global demand for EVs holistically? What percent is this bus and trucks looking to make up?
Okay. Bus and trucks, I think, if I recall, my numbers are about 9% of the demand by 2030, and that's on a 4.3 million ton demand.
Okay, so 10%, 9 to 10% of the total lithium, or 9 to 10% of the total units?
9 to 10% of the total lithium demand.
Yeah.
Yeah.
And then how about the battery stationary storage?
Wow, that's a very, very interesting topic, right? So battery storage. Now, what we are seeing around the world, why battery storage is going to go exponential in a few years, is because of negative electricity prices around the world that we are seeing. So much solar has been installed, 444 gigawatts last year, almost 600 gigawatts this year, and probably 800 over the rest of the decade, right, per year. That has driven electricity wholesale prices down to the negative levels in so many places: California, Texas, European countries, Germany, France, Norway, Sweden, Finland, all the Scandinavians. That really means you cannot bring a new solar project into the grid without storage. Everybody's producing at peak in the middle of the day. If you don't have storage, your electricity literally has to be grounded, just wasted, right? And that means that batteries are an essential new part of the solar farm system right now. Without it, there is no real incentive for you to put a new solar plant into the system. So how many hours of battery storage do we need? We need at least 2 to 3 hours nationally to transfer the power from the midday to the peak period in the evenings, right? So if you do the math, on 600 gigawatts of new installations, we're not even talking stock of production, we're just talking new installations, right? 600 gigawatts of new installations times 3 hours, 1.8 terawatt hours of battery storage will be needed. How many batteries are being produced this year? About 1.6 terawatt hours, or probably less. So we need more lithium than the world can produce today to put in 3 hours of storage at the end of the decade. No, sorry, even this year on the 600 gigawatt installation.
How much are being attributed to household batteries and how much are being attributed to, I guess, bulk storage outside of houses?
All this is purely grid outside of houses. Inside the houses, what we call behind the meter, right? Accounts for about 30 plus gigawatt hours last year, and probably in the 30s, 40s this year. But we are not even adding that. That's almost a rounding error compared to the 1.8 terawatt hours that we could be talking about if we install 3 hours. But this year, last year, grid storage were about 97 gigawatts around the world, gigawatt hours around the world. This year is going to be higher than that. But overall, the picture just means that we are installing 20 minutes of storage this year out of 600 gigawatts of new solar installations. We are far from being at the level of what is truly needed.
Yeah, so because do you think there's going to be much of an uptake of I know there was the rage, years ago, everyone to get solar on their roof, and there was the incentives to do so. Do you think we're going to see the same for the battery storage as well to sort of really, so we're not putting as much back into the grid and we're getting powered at night?
Oh, absolutely. Look, both solar panels and battery prices have absolutely collapsed. Solar is going through an overcapacity, overproduction situation in China. So they are desperate to get rid of the product, to sell it, move it out. And that has led to people installing solar panels everywhere, fencing, side of your houses. The most inefficient places to put solar, but because it is so cheap, they're putting it there. That's what drives demand, right? When things are so cheap, the volume demand just goes up like crazy. We are seeing the same thing happen for batteries in the behind the meter space as well. Battery prices are moving down very quickly. It's gotten to a place where it's so attractive. I'm hearing stories of people putting 15, 20 plus kilowatt hours of storage at home, right? And this lower price definitely stimulates demand, not just in home batteries, but also in grid. That will come in a huge way. We are talking multiple gigawatt hours of projects, each project right now that's being discussed and announced. And of course, with lower prices, we are going to see a resurgence in EV demand. No analyst out there today dares to project EVs. The growth rate going from 100% is always been down to 20% this year, right? Nobody's projecting a resurgence in the growth rate. But when prices are low and EV prices fall below ICE, right? It has to be a tipping point where the growth rate accelerates again, and then it just takes over the entire new sales. So that's what we are seeing.
This is a point you kind of, I mean, it's kind of clear when you tweeted out the Saudi best kind of project that got approved a few months ago, 7.8 gigawatt hours to be completed in 1 year, which is the equivalent of 92,000 cars worth of batteries. It's those like large best projects which I imagine really move the needle, and they stack up from the the investment case, because you have such a dreadfully cyclical nature in grid thanks to solar penetration in some ways.
Yeah. I made that post, did I?
Sorry?
I did that post, did I?
Yeah, you tweeted July 7th.
Yeah. Trav knows your post better than you do, mate.
You guys know me better than I know myself now.
How do you think about the fragility to the thesis, YJ? So, I mean, to start with specifically the battery storage component, is it the ability for the world to find the lithium? Is it the datedness of the grid in the Western world for it to kind of be feasible? Where do you kind of see the biggest points of contention when you study and put the case forward?
Yeah, so the other risk that we are seeing right now is yes, grid capacity as well. And there have been some reports that there's so much new additions in solar in BESS that the grid cannot keep up. So there needs to be new investments. I'm hearing potentially from some we speak to solar manufacturers in China as well, right? So one of them is saying that next year the solar installation in China will be high, will probably be 600 plus, will lead to about a global demand of 600 plus gigawatts as well, but it will probably slow, the growth rate will probably slow a little bit because the grid needs a bit of time to be built out and invested in as well. From the mine side, there could be a risk that companies cut back too aggressively in this period of low prices. I mean, it's all cyclical. The bullwhip supply chain effect applies to lithium as well. So we saw this in 2020. Companies delayed their mine plans. They all shut down, and then we were very rapidly we went into an undersupply situation in the next 2 years, and that sent lithium prices to 80,000. I'm afraid that this could happen again this cycle. Maybe the lepidolite or African supply could come in relatively quickly and temp it off at maybe the 30,000-40,000 range, but it will not be immediate.
What about the disruptions from things like tariff and other sort of forms of government protectionism? This has been like a huge talking point that we've had on the show. That's, whether that be kind of in the government in the US or in Europe, they're really ratcheting these up to quite substantial levels. Does that sort of hinder the thesis in any material way?
I don't think so. We are not being too aggressive on the EV penetration rates as we are right now, right? 44% by the end of 2030 for passenger cars. These tariffs that we are talking about more or less just potentially equalize the prices of ICE cars and battery cars in those markets where the tariffs are going in. The US tariffs are still, up in the air. I don't think the 100-200% thing is a political talking point right now. The EU side is a little bit more real. They have put in, I think, 10 to 30+% tariffs. So, but that again, more or less just equalizes market prices. And that means that these cars still go in. And even so, I think we've seen, was it Norway that pushed back against these tariffs? They're part of the EU, but they're saying, look, why do I want to be stupid and give my people higher prices for essentially no benefit to myself? I have no car makers. I have no need to have tariffs. Why do I want to subsidize Germany, right? So they are already pushing back and saying, you guys can declare all the tariffs you want, but we won't implement them. So I don't think this tariff thing will be huge. And what we are seeing also in China is that they are going out into all the other big markets in the world. Individually, they might be small, but collectively, Africa is a big market. Collectively, the Middle East is a big market. And they don't care about Western tariffs. They want cheap and good Chinese products. So what I don't think tariffs will be a big thing in the impediment of Chinese EVs going out and to this thesis. And I think we just saw BYD's second car carrier get completed yesterday, right? So
yeah.
So what we are seeing is, for the first time in history, a car manufacturer integrates so perfectly across its verticals, right? BYD's got its own battery plants. I think eventually they'll even have probably interest in some mines. They have their own car manufacturing. They have their own export. They have their own export vessels. No car maker in the world has, a 7,000 car capacity shipping vessel, and they are building, I think, was it 7 or 11 of them, to essentially make sure that no car carrier can decline shipping their product overseas.
So you obviously run this clean energy fund. We've spoken heaps about lithium and a bit about the EV sort of makers. Are they the real kind of pockets within the broader clean energy, if you like, kind of market that you play through the fund? Or are there other sort of niches, whether that be sort of battery makers that you think sort of represent opportunities out there that you're kind of excited by?
Yeah. So we talk about we look at many metals. Let's focus on the green metal fund, right? Just the metals. Of course, we are super bullish on lithium, but at the same time, we are very heavily invested in silver. And we look a little bit into copper, nickel, graphite, cobalt, all the other metals. But right now, our other main area of focus is silver.
Why?
Well, we are back to the solar story again.
Oh,
right?
I could have picked that one.
Yeah, so we are talking about installations around the world, 600 gigawatts this year. Not many people know that how much silver is being consumed by the solar industry. So early in 2000, it was next to nothing, right? But a big black solar panel, all the bright lines running across them, right? Those are silver. Every single panel uses a little bit of silver, but when you multiply that little bit of silver by 600 gigawatts worth of production and installations every year, that adds up to a really large number. So I think you saw in my slides this picture of this solar plant in Abu Dhabi. That one is a 1.3 gigawatt plant, and that itself consumed 30 tons of silver. So this is yeah. And right now, currently, world installations are 450 times of this. It is literally unimaginable. We cannot imagine 450 times of this, right?
Wonder how many bloody tons of silver that Silverstone have put in their solar panel arrays. Especially this one we could see on the picture here.
That's a pretty damn spanking sexy operation they got going. I wonder if they used the name Silverstone came out because they were so fortuitous. They knew that this demand for silver, for all of these like solar installations would be such a big deal.
I know. And look, and with those plants, those they all look good from air, but they do get dust accumulation, and they do need to be washed regularly.
They do.
Why not use the Silverstone turnkey water offering as well to supply the water to wash your solar panels installed by Silverstone as well? Holy snap and duck shit. And
Matthew, there's more.
When we're talking water, Trav, even just the first steps, the surveying of the area for where the water piping's going to go by the Silverstone team, the bloody earth moving and the clearing, and then all the pipe digging, installation, joining, connecting, just, mate, absolute turnkey mine management, turnkey water management, turnkey energy management, just an absolute quadruply vertically integrated mining services provider Silverstone is.
I think you've put it on a silver platter for the industry.
Haven't we? What, mate? And you know what they eat? They eat Silverside for dinner every night, those guys, just to keep that Silverstone, that silver going. And but it's quite. I'd probably call them, in terms when you think about all the water work, the energy work, the solar work, I'd nearly call them goldstone, because I don't think silver. They're far from a silver metal. So, mate, love your work, Silverstone. Don't forget about every single offering these absolute legends have, especially the survey and the water.
Go Silverstone.
Go Silverstone, gold medal.
So what happens is that the solar silver demand, this is the next slide, 28, went from nearly zero in 2000 to about 16-20% of global silver production last year. And what happens next? The solar capacity and production in China is growing from 400 plus to 800 in the next few years. It's doubling. The next generation of solar panels, right now they shifted from PERC. The next generation is TOPCon, and the next generation is heterojunction, right? These next generations use even more silver per panel. So what do we have? We have a multiplication, doubling of the volume. We have an increase in the silver intensity used per panel. And we are going to go from, let's say, with 16% of solar use of silver towards 30 plus 40% by the end of this decade.
An increase in the silver intensity per panel. That's interesting, right? Because like I was under the impression that the trend for so long with the the metal intensity in these solar panels is they get less and less intensity because they become more efficient, or at least that's the story that's told by the tin barons in relation to the tin intensity in these solar panels. But so you're saying that trend's kind of reverse for silver, and they'll become.
So what you're talking about is called thrifting in the industry. So as all these manufacturers want to cut their costs, to bring down the cost and to make their production more efficient, they try to use less and less of silver per panel. But that is in relation to a current existing technology, right? The current process, the current technology, you can use less of it every year. It happens, yes. I think it's about maybe between 5 to 12% reductions in the intensity used per year on that particular technology. But they are moving to the next technology to try to squeeze more solar yield out of the panel. So we've seen yields go from this is the yield of capturing the sunlight into electricity, right? So we've seen the yields go from the low 20s now towards the mid 20s. Some are even reporting peak potential yields in the 30s, right? At 30%. So this requires a shift in the technology, a change in the technology of the solar panel. So the next one that they are already moving on to in a big way is called TOPCon, and the next one is called heterojunction. By trying to squeeze more yield, you have to use a different process. You have to use more silver because to increase the conductivity of the panel. And that means that we are starting again from a higher base of silver intensity before eventually when they make these productions more efficient, they try to thrift it down again.
Gotcha. So it's like a one-off sugar hit when you change the technology, but the general trend.
Exactly.
Yeah.
Exactly.
Gotcha.
And how do you kind of think about a decline in the usage of silver from all the other applications as the kind of price rises in your thesis? Is there sort of wiggle room as those people substitute, or is it just the fact that silver is best in class for its conductivity and you can't really substitute it for those sort of niche industrial kind of uses that it's used in?
Yeah, so you are right in that point, in that it is very, very difficult to substitute away from silver, especially in the applications where you need or want very high conductivity. And the other main issue is, it's not an issue, it's actually a great thing, that silver demand, a lot of it is jewelry, right? And a lot of it is investment purposes, hoping that in bullion, in bars, in coins, in silver ETFs. So what happens is that these demands are actually pro-cyclical. When prices go up, demand goes up. Because look at what's happening with gold, right? When the price of gold goes up, Costco starts selling it in supermarkets. People start grabbing it up, in the anticipation that prices will go up further. So
same with lithium stocks, mate. People just jump on board once they start running.
Yeah, exactly, right. So this happens in the financial markets. So what I see for silver as a final potential kick to the silver price is when these financial demands start coming in. Today you want to buy silver, you don't actually go out to buy silver. You sit in front of your computer, you press a few buttons, you bought yourself a silver ETF. Then it is up to that silver ETF to go buy the physical bullion to back it up, right? And that makes it so easy for demand to come into the market right now. And silver ETFs hold only about 10% of the AUM, assets under management, of gold ETFs around the world. So gold is going up. Gold's doing great right now. Everybody's piling their money into gold. What I think happens later in the next part of this cycle is that silver prices start moving as well because of this industrial demand, because of from solar panels, right? And lower interest rates. Once prices start moving, investors are going to start realizing, oh, I don't have enough silver. let's move 10% of my gold AUM into silver. And that just doubled the silver ETF.
Sorry, I wasn't being rude being on the phone. I thought I just wanted to put a bit of context to that 30 ton of silver that you quoted for how much was required for that. But so that's 1 million ounces of silver. So that's about a quarter of the future production coming out of Adriatic's VRIFY mine when they're at full production. So that's to quantify how much that is for one plant. So that's obviously for that purpose which is obviously not just what silver's used for in relation to gold and everything. So that's a good chunk of silver that goes into these things.
Yeah, I know, right? I mean, we literally cannot comprehend how much these volumes, these tonnages are until we actually compare it to something else. Now, of course, granted that Abu Dhabi solar plant technology was a little bit older, they used a bit more silver. They will use a bit less now. I think probably instead of 30 tons, it might be 25 tons. But it is still, like you say, a huge proportion of a single company's output. And that's just one plant.
It's really interesting, right? Because like there's so many companies that market themselves as a battery metals company. But like, you know, all of the battery metals companies we can think of, none of them have added silver to their portfolio of metals to market themselves as a battery metals company. Well, none that I can think of.
Yeah, well,
that'd be an energy transition company, wouldn't they?
Well, I mean, battery metals is a bit of a stupid name in my opinion anyway.
Yeah, energy transition
Yeah, but silver is a very, very specialized thing, right? Lithium and iron ore, other stuff, you can go out there, mine it, ship it to refiners. But silver is quite tough actually. The process of mining it is just like gold. And there are a lot of byproducts that come out of silver mines, or rather, I should say, silver itself is mostly a byproduct that comes out of other mines. So there are only probably about a third of the mines in the world that are pure play silver. The rest of it are out of mines that produce lead, zinc, or copper gold. So the entry ticket to build a lead zinc mine or to build a copper gold mine is literally $1 billion or more, right? So how many energy transition companies are going to be able to come up with $1 billion in capex to produce, lead zinc, which they not necessarily want to get to the silver?
Yeah, you've got to come up with a story for the lead or the gold, which is a bit more complex.
But I suppose but the lead, there's a lot of lead in solar panels too, isn't there? So is there a bit of a relationship between the lead and the silver for the solar panels?
Not that I'm aware of, actually.
Oh God, didn't bloody TJ say there was a heap of lead went into solar panels as well?
I do remember that, but can't imagine why I'd say that.
Because he's running the lead mine.
Yeah,
exactly. there was the example we had here in New South Wales, Bowden's Silver, and they recently just had their sort of project kind of canned by the locals who said, what's sort of silver even used for anyway? So there's that's a lead silver mine. That's, the one argument they sort of put forward is that lead is used in internal combustion engine vehicles, and the batteries there. And that's a sort of, fading kind of industry. So that was used as a point of critique without looking at the other side of the mine that's going to produce silver for solar and all these sorts of things. So it's a bit short-sighted, but that's a whole nother sort of political type issue.
Yeah, but I don't blame them. Investors want you to produce metals that are really high demand and not just have half your product in demand and the other half not, right? So these are some of the problems that exist in the silver market, which is why we think silver supply cannot grow easily. It's not like lithium where you suddenly have lepidolite and clay and what have you coming out in a very short amount of time. Silver, we don't think can grow that quickly.
YJ, do you have any insights on some of the miners or developers that you find particularly interesting, kind of at this sort of juncture in the energy transition story?
Interesting in what sense?
Like maybe your the Green Metals Fund is allocating to it, or it's on the the watch list where subject to a certain catalyst you might allocate to it?
Okay, I'm definitely let's see.
You can pump your portfolio in, mate.
I don't want to pump my
We've
portfolio.
given you a bloody green light.
No, that's what I don't want to come across as doing. But let me just share a little bit about how we select the companies that go into the portfolio, right? What makes them interesting to us. So overall, we do both top down and bottom up, right? So top down, I've already spent all this time giving you guys the top down, why we think lithium and silver should occupy a large part of the portfolio. And actually, okay, never mind. Don't go there for now. Within the lithium space, or at least for these mines, what we really look for a good resource, one with possibly good grades or low strip ratios, the technical stuff that we dive into the DFS or PFS and try to see why we like this more than other assets. We look for trustworthy management. We don't want management that, for example, touts their pre-tax NPVs. I think we know who that was. I think finally they've swept out all the old guys. We don't want management that promises a technology that is unproven and basically promising huge volumes in the next few years while there's no real technical basis for it. I also look at management behavior in the sense that I've run a few of my own businesses before, so I have a bit of entrepreneurial experience. I can put myself in the seat of the management and think, would I do the same at this point in time in the business, or would I not? So if I were a pre-revenue company with many years before even the first construction begins, would I hire a whole suite of board members? Would I hire multiple C-suite executives, a chief accounting officer when there is no revenue to account?
Flying business class, mate.
Right. So that layer of management integrity is very, very important to us as well. So I look for a clear financing plan. I look for a healthy project timeline that is not, first production in 2031. I look for volume growth in the next few years, and that's really very important to me because if this company can deliver this volume this year, higher volumes in the next few years, that means that the lithium price can stay exactly where it is today, and provided the company is cash profitable or even profitable today, they will be able to deliver revenue and profit growth over this period without the lithium price moving at all. And of course, then the final picker is a good exploration upside. So if you look at slide 34, I give a little bit of a sneak preview into one of the mining companies that we cover and that we are actually invested in. Please don't try to go figure out and tell everyone what this is, but this is how we do it. We forecast the production volumes. We have our own price curve. In the base case scenario, it tops out around 30,000 in 28 to 30, and then I constrain it down to 25,000 for the foreseeable future, or at least until end of mine, just to constrain my DCF value to a much lower value than if it were at 30 or 40,000. And if you look at slide 36, I share a little bit about how I discount these DCS. I use a much higher discount rate than what analysts and even other investors do. For producing mines, I discount them at 12 to 14%. Right? I'm pretty brutal on this. I want my 12 to 14% discount. Because the discount rate is essentially a required return.
Yeah.
So for me as a fund manager, I require these mines to return 12 to 14% to the investor, right? At the asset level. Yeah. And then for the mines that are further out with, financing or other hurdles to clear, I discount them at 16 to 20%. For those that are really far out with high uncertainties, I discount at 25% effectively to negate their entire contribution to the NAV.
Gotcha. So rather than risking the cash flows like you see some analysts do, you just kind of are more punitive with a different discount rate by project.
Correct. I have such a punitive discount rate that if you actually bring these discount rates down to all 10% or something like that, right, my target price could double beyond what it is in my model. But why I'm here today to share with you guys is that the lithium sector is so bombed out right now, even on low lithium price assumptions or a lower but rising forward curve, a bit of volume growth. We have companies with 162% upside in this case, and you can see a little bit of a hint there is in a Canadian valuation. So yeah, so if you bring the cost, if you bring the price of lithium up a little bit, if you bring the discount rates down a little bit, we could go to 203%, 300% upsides. That's what we look for.
With your outlook and the combination of the top down and bottom up, YJ, would you be as bold as sort of, being quite confident that the lithium market has bottomed? Do you think we're there?
Yeah, I will go out on a limb here, yes, and say that it has bottomed out. The lithium price is now so far into the cost curve that we have companies shutting down and putting these project delays whose effects on the supply balance over the next few years they cannot see because they don't know how big the demand is going to be. I think if we look at this other slide with the supply demand balance, which is slide 15, yeah, you can see that we think that demand goes to about 4.3 million tons by the end of the year, by the end of the decade. We think that supply maximally, and this here is net of some of the refining losses along the supply chain, right? It goes to about 3.9 million tons by the end of the decade. There's still a gap here. No single, and this gap is very, very real because it requires new mines, new projects to come online that we are not tracking at all here, right? It needs to be a surprise. Lithium prices need to be high enough for all the lepidolite being imputed in this model to come online. Lithium prices need to be high enough for all the DLE to produce. It needs to be high enough for Thacker Pass to produce, right? And all the other higher cost sources to actually come online to make up this, to bring the global supply to just 3.9 million tons. And even so, it's a deficit. So this just next year, well, since we are all short-term focused, right? Next year, I think we go from a large oversupply this year to closer to market balance.
Well, that was a rip snorter of a chat. We had to cut him off a bit there early. We had a little memory card run out, but we thank God it ran out at an hour 10, not 10.
That's true.
that was positive. But
you got
we only lost
stuff.
5 minutes. Sorry, YJ, but mate, sends a ripping yarn, and
awesome.
as I said, bloody lithium MDs are going to be tingling listening to all that.
He's big on Twitter. Give him a follow on Twitter. His handle is at usually YJ Lee. So keep following him on Twitter. He's big on Twitter.
YJ, the GC.
Yeah.
Love your work, bloody YJ. Mate, have I told you how good Axis Mining Technology is
Never.
in the last week or two?
No, I haven't heard it.
There you go. I've told you.
Oh.
Just remember that, everyone. Your trusted advisor in drill hole survey instrumentation. Geez, everyone else is freaking awesome on this list too. Mineral Mining Services, MMS, VRIFY. Holy snap and duck shit. ADIA, get your tickets for Drill 24, mate. Tickets are going brilliant there, so get in while they're still available because I reckon we're selling that thing out. Drill 24. Mate, DSI, Underground, Silverstone for the gold medals, CRE Insurance, Greenlands Equipment, K-Drill, and you didn't see a Spark chart, but you can see it on your own computer if you sign up to Spark. Thank you very much. Hoodaroo.
Hoodaroo.
Beautiful.
The information contained in this episode of Money of Mine is of general nature only and does not take into account the objectives, financial situation, or needs of any particular person. Before making any investment decision, you should consult with your financial advisor and consider how appropriate the advice is to your objectives, financial situation, and needs.